How's it going, everybody? This is Beat the Bush. Today we're going to talk about how to invest your money as in trading stocks in a brokerage account. I've actually been trading for over 10 years and I've learned a few lessons along the way, so I'm going to share these really briefly with you. I hope these tips are self-evident enough that once you hear them, you're gonna go, oh yeah, why not? Of course. I'm not gonna be recommending any specific stock because it's more important to have a overseeing attitude towards investing rather than just me saying, oh, buy this or buy that. A lot of times when people say investing, they're really just gambling, because if someone has maybe $1,000, they say, oh, I wanna invest in something, I'm gonna go pick a stock. The saying goes, you really should not put all your eggs in one basket, because number one, if you have $1,000 and you spend it all on one stock, however many shares that you can buy with that, let's say it went from $1,000 to $500, you have no way to recover from it. I know a lot of people say diversify, but then when you have a limited amount in your brokerage account, you can't really diversify all that much, because your trading fees will actually cover up most of it. Let's say you have $1,000, you do a trade, it's like around $10 to do one trade. That's already 1% of your return. That means you have to make more than 1% in order to cover the trading costs. So it becomes not feasible to diversify this $1,000 into, let's say, 10 different stocks. Now you're gonna go, oh, why don't I just buy like a mutual fund or something? Well, for me, I never had a good experience with mutual fund. Number one, they have really high fees, so once you get that, it's gonna eat into your returns. As an early investor, you might not be sophisticated enough to be able to know what kind of mix of stuff you should buy. As an overall thing, if you have only $1,000, it might just be better to not buy anything. Wait till maybe you have $10,000 to invest, and at minimum split it up into 10 pieces. When I had $10,000 in brokerage account, I couldn't resist. I don't want to buy just a $1,000 chunk of something because the trading fees is a lot in comparison. A really comfortable amount to do trading is around, I'd say, about $10,000 per stock. So that means you have to have a pretty sizable brokerage account. You need, I don't know, $100,000 in order to do your trading, so that the trading fees does not become a significant portion of your assets. I mean, if you're starting out, you can't going around having $10,000 of each stock. That's quite a bit for most people. Whatever you're comfortable with, if you have a large enough brokerage account, they actually will give you free trades. You can use Scottrade, which is only $7, E-Trade $9.99. It adds up if you do your own trading now and then. Studies show that if you do less than a couple trades a year, you're most likely not gonna do all that well. I've been trading a while and I've had mixed success, because in the beginning I just go, oh, you know, I heard about this stock, oh, let me look at it for a while, and then I get excited and I go buy into it. It seems like if you hear about a stock, you kind of get fixated on that single stock. The thing is to not do that, because what are the chances that someone tells you about this stock and then you happen to buy and then it goes up, right? The thing that allowed me to have a more consistent return over the past few years is the Warren Buffett saying of where you should actually buy for value. Now I have an analog to that. I do a little bit of resale here and there, and I found out that I'm really good at spotting a good deal. That means that when I buy something, I already know that when I go and resell it, I'm gonna make a lot of money. So I kind of took that and applied it to investing in stocks. I looked at the stock and I see if there's good value in it. Now, in order to figure out if there's good value, you need to know how to read financial statements. You know, the lingo, PE, price to earnings ratio. PE has to be reasonable for the industry it is in, because that ratio, it kind of changes from industry to industry. For tech, it's generally much higher, mainly because there's a lot of expectation for future returns. Look at Amazon and Netflix. They have PE ratio in the hundreds because they expect them to make a lot more. The thing is, I look at that and I get really scared for those high-flying PE ratio stocks. Maybe I'll get into it later, but currently I don't get into that because it looks really scary. Because for one, Amazon doesn't make any money year after year because they're investing in their business. Let me not get too much into that particular stock. The thing with stocks is that there's a lot of them out there, right? And you should only pick the industry and the stocks that you actually understand. Just because you looked at one doesn't mean you have to buy into it, right? So you should look at a lot of different stock, look at their financials, look at their products, all the products they make, and actually pick out the best of the best one that you feel have the highest of the highest chance of being a really good value. You buy the thing. And one great saying I've heard before, I don't know where this came from, is that when you do the resale and you buy it, you actually make the money when you make the purchase, not when you sell it. Let me explain this a little bit. I buy a stock and I already know ahead of time, I'm very sure that it's undervalued. I buy it and I don't really care how long I hold it for. I know its intrinsic value is much higher. All I have to do is I buy it at a discount today, and then I wait a while for someone to knock some sense into the market, and then it goes back up. You can then sell it at nominal value, or you can wait even longer, wait until the market is going crazy over the stock and overvaluing it, and then you can sell it. One last pitfall I fell for before, which I'm sharing with everybody, sometimes you can really like a company for its products. Maybe you like their product a lot enough that you want to buy their stock. The thing is, there's a big difference between how you like that single product and the company itself, because the company could be making a bunch of different products. Maybe the product that you really like only makes 1/4 of the revenue for the business. That means there's 3/4 of other stuff that they're doing that influences the stock price. What you want to do is when you go and buy the stock, you actually need to understand the whole market that the company plays in and not just one small sliver. What would be even better is if you understand the market and kind of know where is shifting towards, what kind of new technology is going to come out, how is it going to shift it, etc. Another thing is to know about the market psychology. You just look it up. It looks like a sine wave, right? And then people get more and more excited, it gets overvalued, and then it starts coming down, which I think where the economy is right now, it kind of dipped down a little bit, and people are getting a bit more crazier and crazier in terms of selling. It's accelerating in terms of the sell. Right now it's January 2016 and it's starting to go down. I actually have no idea if it's gonna just pop right back up or keep on going down. I don't know. Usually that's how the psychology goes. It repeats itself over and over again. It gets overvalued, people get scared, people run and hide at the bottom, until at the very bottom no one even wants to buy anything until it comes up again, and then so begins the cycle all over again. The thing is, most people cannot time the market very well. I know I've been guilty of trying to time the market. So thanks for watching. Don't forget to let me know if you like this type of content. I'll make more down in the comments section. Like this video and subscribe over here. Thanks for watching.